Can you hear me without the microphone? That's okay? Oh, you're not going to hear me. Oh, okay. I'm not so used to, I feel like I'm going to sing. So it's great to be here. It's great to see so many people here. So today I'm going to talk about private equity. Let me first say two things though. I'm not incredibly knowledgeable about Russia. But I have been 4 times here in Moscow. The third time I was in Moscow was in 1990, so I don't quite recognize everything. The other thing is I have spoken some Russian, because I did Russian in military service, but unfortunately the only word I remember now is transportion, and it's not so useful for this lecture, so I will have to do it in English. Истребитель, no, okay. So today the topic is private equity, and what I was planning to do is give you a background about what we know from research about private equity. This I've kind of said already, but the fund basically ends up being, a 10-year fund, although typically you have the option to extend it for 2 years if it turns out that you haven't exited all your companies. And the first part of the fund life you invest, second part you're supposed to exit or sell these companies. And then private equity firms, once they've basically fully invested the first fund, they typically then start raising the next fund, because the workload obviously gradually going to go down as you sell the companies in your portfolio, and then you free up resources to start your new fund and keep on investing. So these funds, I would say, account for probably 80–90% of all the private equity activity in the West, although there are some exceptions, right? There are some publicly traded companies like 3i in the UK that invest in private equity, and there are obviously family offices that try to work like private equity funds and so on. But these funds dominate in terms of the capital allocated to these markets. Now, one very important aspect of private equity is who gets paid what. Okay. First question one should ask when investing or raising a fund. The funds, as I said, are set up as limited partnerships, and hopefully the interpreter knows what the name of that is in Russian. But so basically, you have 2 types of partners, 2 types of parties to this fund. The investors who provide the money in the fund, they're called limited partners. And the reason why they're called limited partners is that they have limited liability. So if basically the only money they risk is the money they put into the fund. But for example, if something bad happens and there's a lawsuit or something, they have limited liability. Then we have the general partners. The general partners are the private equity partners, okay, so the people working for the private equity firm, those are the general partners, okay. So if we take KKR, okay, the KKR's fund, well, the investors would be CalPERS and some sovereign wealth funds and institutional investors. They would be limited partners, and Henry Kravis and George Roberts would be limited partners, okay. So now, as I said, the limited partners, they provide most of the money in these funds, and in general, when these funds started in the early 80s, traditionally the limited partners would invest 99% of the money in the fund, and the general partners would provide 1% of the money in the fund. Okay. Now, I think nowadays investors would like to see the general partners put in more than 1% in the fund, especially if they have previously been successful, because they would like the Henry Kravis and George Roberts to have a substantial, as we call, skin in the game, or substantial stake to get the incentives right. Then, okay, you put money in the fund. You invest money for the first 5 years, then you exit your investments, some money comes in. How do you split the money that comes in? Well, the general partner, okay, so Henry Kravis and his team, they first get a fixed fee, what's called a management fee, which is a fixed percentage of the capital committed in the fund. And this varies between, say, 1.5% and maybe 2.5% of the total commitment of the fund. The larger the fund, typically the smaller the management fee, because the idea here is that you're not supposed to get rich from the management fee. Okay, you're supposed to be able to cover your office and bare minimum. You know, the porridge Henry Kravis eats for breakfast is supposed to be covered by this management fee. While the carried interest, he doesn't eat porridge, by the way. That was a joke. So how are you supposed to get rich? Well, you're supposed to get rich from what's called a carried interest. Okay, so this is a profit sharing agreement, and this is very standardized in the private equity. So I would say 90% of all funds probably have a 20% carried interest. So this means that 20% of the profits in the fund go to the team, okay, to Henry Kravis and his team. And there are sometimes some hurdle rates that you first need to meet, an 8% return per year, for example, before you get your profit interest. But what's interesting is that this 20% thing is very standardized. So that means basically, say that I have a billion euro fund, okay, and then I'm very successful. So let's say I triple the money over this period. So I now have 3 billion in my coffer. Then I have 2 billion in profits. Okay, so 20% of the 2 billion. That's 20% of the. That is 400 million. I just came up with that. 400 million goes to the team, and then 2.6 billion. So what's left there goes to the investors. So that means that if you're a successful private equity partner, you have $1 billion fund and you triple your money, there's quite a bit of money coming your way. Okay, it's very high-powered compensation. Sometimes when I meet people in the industry, I'm sometimes puzzled. So why is it always 20%? You know, why not 17 or 22? Okay. And I get various answers to this question. One answer was that, well, in New England in the 1800s, when the whaling ships went out to hunt whales, they split it 20%, 80%. Okay? Then I asked some other guy, and he said, no, it's when the ships in the 1700s went to India and China for spices, and then they came back, they split 20%, 80%. And then the third answer, no, in the Bible it said, you know, if you have 5 years, put 1 year of seeds in the... Okay, so apparently it's given from above, okay? Thank you. But I think currently this is quite interesting, okay, why it's so standardized. My feeling, and I'm going to come back to this, is that maybe fees in this industry are somewhat on the high side, but we can talk more about that. Okay, so one interesting thing with this market is that it's very cyclical. Most financial markets are obviously cyclical, but private equity has very pronounced cycles, so they go up and down. This picture is meant to illustrate that. This is for venture capital, so investments in early ventures, and these are actually only US funds. So this is the amount of funds that in a given year is raised by venture capital funds in the US, and it's normalized or standardized by the size of the US stock market. Okay? And what you see is that it kind of goes up and down, and then you have a big up cycle here, which I think you can probably guess the year, even though it's hard to see. Okay, this is the internet boom. So in 2000, there was a historically high amount of fundraising in the venture industry. And then after the crash, it dropped, and then we had a bit of an upcycle in the recent sort of financial boom, and after the crisis, it's dropped again. Okay, so it goes and follows the cycles very pronounced. This is for buyout, so this is for fundraising into more mature companies, and you see similar types of cycles, although the historic boom in the buyout industry, as you probably know, was during the recent credit boom, okay, where it reached amazing levels, okay, more than 1.6% of stock market capitalization. Now, 1.6% of the stock market may not sound that much, but remember, this is in a given year. This is the flow in a given year. So if you want to understand how much money total is invested at any given point in time, well, think about going back 6 or 7 years and accumulating the amount of money, okay? That is more like the amount of money invested in the private equity market in a given point in time. So we're closer, currently I would say, to something probably like 10% of the size of the stock market. Okay, so the question is, these private equity investors, are they doing anything good or not? And I want to give you the academic perspective on this, because there's also a popular perspective. I don't know about how much private equity has been in the news in Russia, but in Europe it has definitely been in the news. Okay, and a lot of the popular press, as well as, say, labor unions, have been very critical against private equity, okay, and said that they're basically asset strippers. They buy good companies and squeeze out all the money they can get, and then they leave these companies to die. Okay, that's been kind of a very common story. As a result, actually, the European Union introduced a new regulation directed to private equity funds and hedge funds, which they like to throw in the same bin. They're both evil. But anyway, academics actually, turns out, have a much more positive view on private equity. Okay? And I would say it's not just because we have professorships that are funded by private equity funds. It's not only because of that. It's also because the facts are actually quite strong, in particular when you look at whether private equity funds add value to the companies that they own. Okay? And the first academic that started looking at private equity funds was Professor Mike Jensen at Harvard Business School, who wrote a very classic paper in 1989 called The Eclipse of the Public Corporation, which means basically the disappearance of the public corporation. So in this paper, which was written in 1989, he predicted that private equity is such a successful ownership model that in a few years we won't see any firms owned in the public stock market. Okay, it's all everything will be private equity, because private equity is so good. Okay, now it was a bit premature to write that article in 1989. So there was a buyout boom in the U.S. in 1989. I don't know if you've seen the movie Wall Street. Okay, Gordon Gekko. I don't know if that rings a bell. Okay, this was, you know, the 80s boom. Okay, but then there was a crash, because the junk bond market crashed and so on. So obviously the private equity didn't take over the world at that point. But then, maybe now it will. Okay, so maybe you should have written the paper 20 years later, or 30 years. Anyways, why did Michael Jensen like private equity? Why did he think this was such a good ownership model? Well, he thought that private equity solves a very tricky corporate governance problem. Okay? So corporate governance is, corporate governance is about making sure that managers work in the interest of the people who provide them with capital. Okay? Because managers work with other people's money, and it's easier to be wasteful with other people's money compared to your own money. Okay? So owners need to kind of monitor and look after the managers so that they do the right thing, and that is really what corporate governance is about. Now, the problem you have in public stock markets is that in order to be an active owner, you need to own a lot of a sufficiently big stake in companies, because if you only own a little small, a few shares in a company, you neither have the power nor the incentives to be very active, okay? Because you don't have a big stake in the company. On the other hand, if you take a big stake in a company, you have very bad diversification. You take on a lot of risk, okay? Your portfolio is going to be very undiversified, okay? So this is sort of the conflict, right? You want diversification to reduce risk in your portfolio, but you still need to be active, an active owner. So how do you solve this problem? Well, this is where Jensen saw private equity funds come in, because private equity funds, they raise money from institutions. Those institutions are well diversified, okay? They can put money into lots of funds, lots of private equity funds and lots of other things, so they can be well diversified. The private equity funds themselves, though, they can then take very concentrated ownership stakes in, say, 10 companies and be very active owners. So investors can be well diversified, but companies can still get active owners. So that was sort of the beauty of this model, if you theoretically, okay? Now, when you start thinking about this for a few more minutes, you'll realize that it's probably not quite so easy, right? Because in this setup, you've solved the corporate governance problem of the firm, because the private equity partners, Henry Travis, is now monitoring the firm and the management, okay? But you introduce a new governance problem between the institutional investors and KKR, okay, or the institutional investors and the private equity fund. So this is something that I'm going to come back to. But there you move the governance problem up one level, if you will. Okay, so who makes sure that the private equity fund actually do their job? Okay. But leaving that aside now for a second. So Jensen basically argued that there are three important things that private equity funds do to improve the value of the companies they invest in.